Bridge loans. We're going to talk today how they work, when you may want to use one. But first, I have to ask you a question. Why is money also called dough? Well, because we all need it, of course. Moving right along. It gets better, I promise, okay? We do a lot of loans here, as you can see from that slide there. Lots of different kinds of loans. If you have questions on them, let us know. But we're going to focus today on bridge loans. So here's the scenario. Let us say you want to purchase a home. In this particular case, owner occupied. The purchase price is $850,000. The problem is the buyer does not have adequate down payment to purchase the loan and purchase the home and get the loan that they want. However, they own their current residence. It has a lot of equity. It's worth $600,000. Loan balance is $200,000. So there's $400,000 worth of equity there. What if they could potentially use that? Well, let's look at solutions here. They could make an offer in the new home that is contingent on the sale of their current home. They get the home sold. They then have a down payment. They move forward to buy the new home. The problem with that, of course, is a lot of sellers do not want to take a contingent offer. Someone else might come along with a non-contingent offer for the very same purchase price. And who do you think they're going to choose? The non-contingent offer, more than likely. You could get a home equity line of credit on the current home and use that for the down payment with all that equity that you have there. The problem with that is you have to qualify for all those mortgage payments. You have a current loan on your house, the $200,000 that has a mortgage payment. You'll now have a new HELOC payment, and you'll have the new payment on the house that you're purchasing. With this scenario, you have to qualify for all of those payments in your debt to income ratio. That may be an issue, and if it is, it doesn't work very well. So one other possibility is to use a loan we call a bridge loan to purchase the new home, no contingency, and as you'll see, the qualification is quite different than using the home equity line of credit. So what is a bridge loan? It's a loan that we put on the home that you're leaving, the home that you own. We call that your departing residence. Also, we put it on the new home that you're purchasing. So it's also known as a cross-collateralization loan in the industry. So look at it this way. If you could use both homes as collateral, you'd have a home worth $600,000 plus an $850,000 new home, $1.45 million of value. You have a loan of $200,000 on the current home. Here's the math for bridge loans. You take the $1,450,000, will lend potentially up to 75% of that. That's $1,087,500. From that number, we subtract out any loan that you owe on your current residence, in this case, $200,000. You have $887,500 available to purchase a new home of $850,000. How wonderful that this scenario came out that perfect, like I put it together, right, guys? But I will tell you, lots of times you don't have enough equity, but people have some funds for the down payment. They just don't have enough. So when you add in the collateral, the extra equity you have available for the bridge loan on your current home, that gives you enough funds for the down payment, and you can potentially purchase the new loan home without any contingency. So the buyer buys a new home, as I said, with no contingency. They use available funds from the bridge loan to purchase the home. And understand this, the bridge loan uses both properties as collateral. So the lender collateralizes both properties. Then what happens is the borrower sells their departing residence after they complete the purchase of the new one. The funds from the sale pay down the bridge loan. They end up with a permanent loan on the new residence that is a smaller amount with a payment that gets readjusted to the smaller amount and into the home of their dreams with the payment that they want. I just want to mention there are a couple of options for bridge loans here, and they do have some differences. The one I just described is one loan, which, as I mentioned, collateralizes both houses up to 75% loan to value, pays off the underlying lien on the departing residence. However, you qualify with just the permanent loan payment on the new home. So when the loan is underwritten, even though it's a much larger loan, it's going to be underwritten for the smaller permanent loan that will be there once you sell your home and pay down the large loan to the small amount and the smaller payment. And the term of that loan is 12 months. You have 12 months to pay to sell your home and pay down that loan. But you also have, we have another option for you, which uses two loans, and it does have some advantages. The one loan is on the departing residence up to 75% loan to value there. So there's one loan on your home that you own up to 75%, pays off that loan that you had there, and it sits there for up to a year. And the cash from that loan is used for the down payment on the new home, and we'll go up to 80% of the value on the home that you're purchasing. So you're basically borrowing from your current home with a loan that you do not have to qualify in the debt ratios for. You only qualify with a permanent loan on the new home. There's no repayment required on the departing resident. That term on that loan is 12 months. And one significant advantage of this particular loan product that we have is the properties can be located in different states. So you could have a home in Washington State, and you could purchase a home in Hawaii or purchase a home in Arizona, and you want to move down there to warmer climates. We will allow that with this particular loan. There's different options also to verify income with this loan. The one loan, we need W-2s or pay stubs or 2 years worth of tax returns, like normal qualification for Fannie Mae. This loan, the 2-loan option, we can sometimes use bank statements for qualification of income if you don't have W-2s, sometimes asset depletion. We can talk about those kinds of loans if you would like. So have any questions, any scenarios you want to chat with me about, give me a call. There's my contact information. Happy to chat with you and let you know what we can do. Thanks, guys, for your time today.